This is Margin Machine, where we follow the money behind AI. The most valuable startup on Earth is about to go public at a valuation near $1 trillion, and it reportedly lost $38 billion in a single year. That's not a typo. 38 billion. More than the GDP of some countries, vaporized in 12 months. And yet the smartest investors in the world just fought each other for the right to pour in more money. In March 2026, OpenAI closed a $122 billion funding round, the largest private raise in the history of capitalism, at a post-money valuation of $852 billion. Now the company has confidentially filed IPO paperwork with the SEC, and insiders expect it could list as early as this fall, crossing the $1 trillion mark on day one. So today we're asking the only question that matters: how does a company lose that much money and still become the most anticipated stock offering of the decade? Because when you follow this money, you find something much stranger than hype. Let's start with the raise itself, because the numbers are almost cartoonish. $122 billion in a single private round. For context, that's more than most companies are worth. It's roughly the entire market cap of a Fortune 100 firm, raised as venture funding. Reports indicate the round was led by Amazon with a $50 billion commitment, joined by Nvidia and SoftBank at around $30 billion each. Three of the biggest names in tech, writing the three biggest checks in venture history, for one company. And the valuation, $852 billion post-money, makes OpenAI worth more than almost every public company on the planet. All of this for a business that, according to its own reported financial disclosures, posted a $38.5 billion net loss in 2025, with operating losses around $21 billion. On paper, that math should terrify investors. Instead, they oversubscribed the round. Which tells you the people writing these checks are not betting on this year's profits. They're betting on something else entirely, and we'll get to exactly what in a moment. Here's the actual business underneath the valuation. OpenAI reportedly serves around 900 million weekly active users, roughly 1 in 9 humans on Earth touches its products every week. Revenue has reportedly climbed to about $2 billion a month, which annualizes to over $20 billion a year. Those are real, spectacular numbers. Very few companies in history have grown revenue that fast. But now look at the other column. In the first quarter of 2026 alone, OpenAI reportedly posted an operating loss of nearly $7 billion on about $5.7 billion in revenue. Read that again: the loss was bigger than the revenue. For every dollar coming in the door, more than $1 was going up in smoke, before you even count stock compensation, which reportedly adds several billion more. Most businesses improve their margins as they scale. OpenAI's losses have been scaling faster than its sales. By some reports, the net loss widened nearly 8-fold year over year. So the obvious question is, where is all that money going? The answer is a single line item so large it bends the entire AI economy around it. Compute. OpenAI's co-founder Greg Brockman has indicated the company plans to spend around $50 billion on computing infrastructure in 2026 alone. $50 billion, more than double its expected revenue, just to keep the models trained and the servers answering 900 million users. Reports suggest over $17 billion of last year's spending flowed to Microsoft for infrastructure and model training. This is the trap of frontier AI, and it's the part most coverage skips. The product itself is a treadmill. Every new model generation costs dramatically more to train than the last. Every user you add costs real money in inference, GPUs, electricity, cooling. And if you slow down spending to protect your margins, a competitor's next model makes yours look obsolete within months. Anthropic, Google, and a wave of open-source labs guarantee that nobody gets to rest. So OpenAI isn't losing money because it's badly run. It's losing money because in this race, spending less is how you die. The whole business model is a bet that at some point the treadmill slows down and the margins finally show up. But here's the part nobody mentions: the biggest investors in that record round didn't just bet on that. They wrote themselves an escape hatch. Buried in the reporting on Amazon's $50 billion commitment is a detail that changes the entire story. $35 billion of it is reportedly contingent, conditional on OpenAI either completing an IPO by the end of 2028, or achieving AGI. Sit with that for a second. The largest single check in the largest funding round ever isn't really a bet on OpenAI's business. It's a bet on OpenAI's exit. Amazon effectively said, "We'll fund the losses, but only if you take this thing public and let the market absorb the risk." That reframes the entire IPO. This isn't a victory lap, it's a contractual deadline with $35 billion riding on it. And Nvidia's $30 billion? Remember that a massive slice of OpenAI's $50 billion compute budget ultimately flows into GPU purchases. Nvidia is, in effect, investing money that comes back around as revenue on its own income statement. The money moves in a circle, investors fund OpenAI, OpenAI buys compute spending becomes the investor's revenue, and the rising valuations justify the next round. It's legal, it's disclosed, and it's the most elegant flywheel in modern finance, as long as the wheel keeps spinning. So why go public at all? Because an IPO fixes OpenAI's only real problem: it needs more money than private markets can comfortably supply. When you burn tens of billions a year, even soft bank-sized checks are a bridge, not a solution. Public markets are the deepest pool of capital on Earth, and a $1 trillion listing would let OpenAI raise tens of billions more while giving early investors, who've waited through years of paper gains, an actual exit. For Amazon, it unlocks that contingent $35 billion. For employees holding equity, it turns lottery tickets into cash. And for the AI industry as a whole, it's the ultimate stress test. For the first time, public market investors, pension funds, index funds, regular people's retirement accounts, will be asked to price a frontier AI lab with full quarterly disclosure of those losses. No more selective leaks. Every 90 days, the world will see exactly what it costs to run the most famous AI company on Earth. If the market says yes at $1 trillion, every AI startup's valuation gets marked up overnight. If it hesitates, the correction ripples through the entire ecosystem within weeks. So let's close the loop. How does a company that reportedly lost $38 billion become the most anticipated IPO in history? Because everyone in the chain is paid by the next step in the chain, not by profits. Venture investors are paid by the IPO. Amazon's contingent billions are unlocked by the IPO. Nvidia is paid by the compute spending the funding enables. And the public market, if it buys in, is paid only if the treadmill eventually slows and those margins appear, the one step nobody has proven yet. That's the real story of the AI economy in 2026, extraordinary technology, extraordinary revenue growth, and a financial structure where the last one holding the shares needs everything to go right. It might. Frontier AI could become the highest margin software business ever built, that's the bull case, and it's not crazy. But when this IPO prices, watch who's selling, not who's cheering. If you're finding these breakdowns useful, subscribe. We publish follow the money stories like this every week. Because there's one player in this whole saga that profits whether OpenAI's IPO soars or stumbles, and it's not who you think. If you want to know who wins either way, click the video on your screen right now.